John, we got questions galore here, but happy Monday.
Hey, Gary. Yeah, I'm ready for some questions. What do you got?
All right. So I'm going to kind of boil them down here. So this one was from Jesse, and he talks about Ponzi schemes, etc. But he says he'd love to hear from you what you're seeing with these cryptocurrencies like Bitcoin and Litecoin. By the way, we've got a white paper on it. So if you email me, kl@kerrylutz.com, I'll send you our Bitcoin white paper. Why do they need a backing at all? Isn't it the coding mechanism that makes them far too expensive to counterfeit? Is it enough? Does anybody even hack commercial banks anymore? It is quite obvious to even the blue pill overdosers that the dollar has no special cryptographic creativity. I think that's the crux of what he'd like to know.
Well, there are so many moving parts to the cryptocurrency story that you have to be careful once you dig into it, that you don't just get lost in the trees and lose sight of the forest. But when you take a currency like Bitcoin, okay, that's private sector money that doesn't depend on a government keeping its promises for its value and has a limited increase in supply until it tops out, and that's all the Bitcoins that will ever be created. Okay, so as far as that goes, it doesn't need backing, because backing basically just controls the supply of something. If you link the dollar to gold, what you're doing is linking the supply of new dollars to the supply of new gold, right? So if Bitcoin's supply is limited by its algorithm, that takes care of the whole backing question. However,
there's more.
There's more. There's a lot more. What they've been doing with cryptocurrencies is they branch them off from the original stock. You do a Bitcoin fork, create another version of Bitcoin, and then increase the supply of that by some predetermined amount. And then what you're doing then is increasing the overall supply of cryptocurrencies by a potentially infinite amount. So that means the cryptocurrency space is not supply constrained in any way, and you could easily have a cryptocurrency bubble or a cryptocurrency hyperinflation in which new ICOs are coming to market all the time, new currencies are being put out there, and their supply is increasing. So the total increase in cryptocurrencies in the aggregate can be like, Weimar Germany or something like that in theory. So, and if that's not scary enough.
And there's more.
Yeah. Cryptocurrencies are basically pieces of technology. In other words, Bitcoin is a technological creation in the same way that, for instance, an iPhone is or something like that. And it can be superseded by something that does the job better. So, yes, the supply of Bitcoin is limited. And yeah, it does a reasonably good job of functioning as money in its current state. But if something else comes along that's better, some new cryptocurrency that's just in some important way better than Bitcoin, then everybody's going to migrate over to that new and better form of cryptocurrency, and Bitcoin will just shrivel up and die. And that's completely possible because these things are, they're constantly being innovated. New things are coming to market all the time, addressing different aspects of currency and exchange. And so there's no reason to think that there won't be continuing improvement and that we'll migrate to the things that are improved and better and just do the job in a way that we find more useful.
And let's not forget that there are people in this world, most of the third world, most of the world's population do not have bank accounts. So if there is a really stunning technological innovation in cryptocurrencies that makes them bulletproof as much as they can be, blockchain, and make them like universally accepted and issued, and you have all the safeties, supply, maybe the supply is limited or they're backed by a physical asset, like perhaps precious metals, we could see a mass migration into these cryptocurrencies like we never saw anything like before, they could totally put Bitcoin to shame, John, you know?
Well, yeah, they could push fiat currencies off the playing field. The problem is you don't know which one will do it. Which cryptocurrency is going to be the one that wins? What's the Amazon of cryptocurrencies 10 years from now, the Google of cryptocurrencies? You can't know that ahead of time.
Yeah.
And so it's hard to, quote unquote, invest in these things because maybe the space has a bright future, but the individual players within that space are going to rise and fall according to events and trends that we don't see at the moment and we can't predict. So it makes cryptocurrencies scary from the point of view of somebody who's trying to preserve wealth, which takes us back to gold. That has preserved purchasing power for 3,000 years. And it hasn't been superseded by anything that does that job better. It's been replaced temporarily by fiat currencies as a medium of exchange, but that the day is coming when fiat currencies fail as a medium of exchange. Certainly, they're already failing as a store of value, and we'll go back to gold. The same can't necessarily be said for cryptocurrencies, although they might win in the end, or maybe some hybrid gold cryptocurrency thing comes along that ends up being the best of breed in the monetary world. We just don't know. I don't know. I think cryptocurrencies are a fascinating idea, and they've got a lot of good possibilities. But they make me nervous because I don't understand so much of what's coming. I think a lot of the future with regard to any kind of technology is unpredictable. And with cryptocurrencies in particular, because they're not just a new microchip, which is a fairly discrete kind of thing. They're a new money.
Yeah.
and we haven't had a new kind of money come along for a really long time.
Yeah,
so we just don't understand how it's going to go.
Yeah, and it's a form of money that is more well adapted to the technology. We could look at our currencies now as legacy currencies because they started in in the dollar's case, actually being convertible directly into bullion, at first gold and silver and then gold. But actually, without getting into the intricacies, simplifying it. And then they became paper-based. And then from being paper, they became digital, and they're really legacy currencies. So if we look at them that way, and that oftentimes they become more hindrance to commerce than help, then we can see these currencies in a new light. But they're not currencies yet. They're not money. You can't go to Starbucks and buy a latte for Bitcoin or crypto. Maybe you could find one that's hooked into Visa or MasterCard, but even still, it's really of limited utility. So on to the next question here, John. So let me find it. Meredith writes us. I don't know where Meredith is from, but in any ways, she wanted to know a good bullion dealer. I recommended Miles Franklin to her. They're bonded, insured, and licensed by the state of Minnesota. No other bullion dealer that I know of is even allowed to sell bullion in Minnesota, as well as the rest of the country. Miles Franklin, international clientele. But anyways, getting past that, she started listening to the podcast about 3 months ago and tries to listen every time I broadcast. First, Meredith, just go over to iTunes, either on your PC or your Mac, and go to the iTunes store, type in Financial Survival Network, and then click the subscribe button about 8 times. And eventually you'll just get them delivered to you automatically to your iTunes program. You can get notifications and stuff. If you do it on your, in the podcast app, on your iPhone, they'll automatically notify you when we post new ones. But anyway, getting past the housekeeping stuff, do you suggest buying the physical metals? And if so, how and from whom? We already addressed that. Should one buy an ETF? And are the holders of the gold in the ETF honest and audited? And I guess it all depends upon the definition of honest and audited, John. But we both have our own particular points of view on this one, don't we?
Yeah. Physical metal and paper metal, something you would buy like a stock, like the GLD ETF, are two very different things. And you definitely want to own some physical metal because that's something that is money in hand. It's something you can control, and nobody else has to keep a promise for you to have that and be able to profit from it when it goes up and then spend it when you need to. The financial aspects of precious metals are many and varied. Now, we've got a lot of ETFs out there that hold all kinds of precious metals related things. But something like GLD, which is linked to the price of gold, is not actually owning gold. It claims to own a certain amount of bullion in a vault somewhere, but its governance rules, without getting into too many details here, allow it to structure itself so that you really don't own gold if you own GLD. And because of that, it's possible for GLD to get into one kind or another of trouble, and you find out all you've got is an entry in your brokerage account, but you don't actually own any physical gold. So in that sense, it's a short-term trading vehicle. If you think gold is going to spike, that's a really quick way to jump in and ride the temporary or short-term move in the metal, but it's not a long-term holding because it comes with a lot of risks that counteract a lot of the advantages of gold and silver. If you want to buy something that is easy to buy and has a lot of upside potential, even relative to gold and silver, then the ETFs like GDX and GDXJ and SIL for silver, they own shares in gold and silver miners, which are very volatile. But if gold goes up in the aggregate, gold and silver miner stocks will go up even more. So that's a good way to profit from the upside potential of the gold and silver mining industry. So no to GLD, yes to GDX. But if you're fairly new to precious metals, you want to start with physical. Find a good dealer, as we talked about earlier, and then order some gold and silver coins. Get the most gold and silver for your money. Don't mess around with rarity this or pretty design that. Just get as much bullion as you can per dollar that you're investing. And start with that. Find a really safe place to store it, which is a whole different subject, which we can address some other time, I think. But store it as safely as possible, and let that be your core, your financial core. That's the stuff that's going to hold its value and that you can access. So you've eliminated a lot of risks by doing that. And then with more money that comes in, you go on to riskier but higher potential reward things like gold mining, silver stocks. And that's the way you should address the precious metals part of your portfolio. But also don't make that your only holding. You want to own 10 or 15 or maybe 20% of your capital in precious metals, but then diversify beyond that, because you never know, as certain as Carrie and I are, that gold and silver are going to go up over time in the future. Nothing is 100%. And don't ever bet the farm on any one thing.
Just death, taxes, and Donald Trump's hairstyle. Those are the only things that are forever. Hey, so one more quick question, then we'll kind of do a quick recap of what's happening now. So Tom, long-time listener and really all-around great guy. So he's talking about alternative news sites use bogus numbers. He says, we all know that government stats for unemployment, inflation, et cetera, are bogus. Why then do all the alternative news sites use these bogus numbers for their analysis? Why not deny their premise and promote the truth? Like, he's talking about shadow stats here. And we will never know what's really going on if we rely on the lies to come to our conclusions. It's like baking a cake using a blind man's ingredients. Well, the one index that I do really like a lot, Tom, is the Thanksgiving dinner index. How much the cost of a fixed Thanksgiving dinner, and I don't know if it includes giblets or gravy or what it includes here, but the price of Thanksgiving dinner, I think, is probably the best, certainly for food. It's going to have an energy component in it effectively. It always has that because, food is produced using energy, both in fertilizer and in the energy it takes to harvest and whatever else you do. Like, I'm not a farmer. Don't yell at me for being ignorant about it. But, when that thing goes up, all right, so last year it went down from 49.87 to 49.12. And I just think it's a really good indicator or analog. It's not going to tell you about health insurance or car insurance, obviously, or homeowners insurance, any of this stuff you have to know. But in terms of what you eat, it's a really good analog for it. So tell us what you think, John.
Well, I definitely think we should qualify the stats that we use in blog posts, for instance.
Which
and if it's some government-generated stat, you kind of need to say, okay, this is what the government reports. You don't want to say this is what is. But a lot of these things are used by the government to determine policy. So in that sense, even if their number has an accurate measure of, say, inflation or unemployment, if the government is treating it as such, then the number has some validity. For instance, the consumer price index. If the government is looking at that and using that as its measure of inflation when the Fed decides whether to raise interest rates or not, then changes in the consumer price index are important, even if they're not really that accurate. A measure of what they claim to be measuring, if they tell the government how to act, then it matters what it's doing. And lately, for instance, inflation has exceeded the government's stated inflation target, which means they're probably going to raise interest rates a couple more times this year. That's what everybody expects from the Fed now. Mm-hmm. Same thing with wages. We know the unemployment numbers are distorted because we count things that shouldn't be counted and ignore things that should be counted. But if wage growth, for instance, starts to accelerate, which it kind of is, you're seeing at least anecdotal accounts of companies that are, eliminating drug tests because they can't find anybody to work for them, or going to the local jail and recruiting people who might get out pretty soon.
They're recruiting jailbirds. Oh my God.
But see, that's a sign as it translates into wage growth as reported by the government. Even if they're playing games with the numbers, if that number that they report is above the target that they've stated as the point at which they want to start raising interest rates and tightening monetary policy, then those numbers still matter. So you kind of have to understand what it is you're seeing to know whether it's a valid stat as released by the government or not. And in some cases it is, in some cases it's not. So I know that makes it really complicated, but that's where we are now, with some things that are trustworthy, some things that aren't trustworthy, and some things that are trustworthy under certain circumstances. So we should do a good job of explaining which is which in our writings, and I don't think people do that a lot.
I always, when I am referring to the unemployment rate, the U1, which is the one that gets all the headlines, they changed it during Obama's years so that if you stop collecting unemployment or you stop looking for a job, then you're no longer unemployed under that definition. That's the definition we've been hearing all the headlines about, which is it's 3.8%. But on the other hand, so just say we go to the U6, that means unemployment somewhere around 10%. John Williams will argue about it, but I don't think a stat can really capture the true magnitude of it. The workforce participation rate has gone up a bit, but you have to understand that there are 10,000 baby boomers purportedly retiring daily, and I wish I was one of them sometimes. But that really is shrinking the labor force, because now many of you boomers out there can actually afford to retire because the value of your home has gone up so much, the value of whatever stock holdings you had left increased so much. So I think that the number is becoming more accurate, not so much the U1, but the U6, and the workforce participation rate. I think it reached peaks when baby boomers really had to work for their retirement like 10 years ago, and it was at 64% or 67%. I think it's naturally going to fall because Gen X, which is the succeeding generation to ours, John, is much smaller. And then you don't get to a larger generation until you get to the millennials. And a lot of them are starting to get taken into the labor force, even though the stats aren't necessarily reflecting it, John. Am I clear on that?
Yeah. In other words, there are several different measures of unemployment.
Yeah.
And there's a debate about which is the most accurate. But clearly, if what's going on, half the workforce now is not working or looking for a job, and so they're not counted in any of this, that's a different thing. That's new. We've never been in this statistical territory before. So there is a big question about what it means, and if the workforce, the viable workforce, is actually shrinking, so that we really do have, of the people who can work, only 3% and change of them out of work, then what does that mean? That's a long debate.
I think it's meaningful, though. I think it's really meaningful, John.
Yeah. I mean, it means something. But what does it mean? And that's a question that economists are debating right now. Mm-hmm. But I think, combined with anecdotal evidence that companies can't find anybody to work for them anymore, it implies that the labor market is pretty tight. Mm-hmm. And so you combine that with house prices that are surging, and you get and of course, stock prices that are at record levels and junk bond prices that are at record levels. And you get a sense of a market that's overheating out there. Mm-hmm. So whichever stats you want to use, they're all kind of pointing towards a blow off top here.
Yeah.
And I think that's really the important thing to conclude now, is that we're getting to a fairly familiar place in the cycle. Even it took a really long time to get here, and statistically it was different from previous expansions. But now we're getting into familiar territory where companies can't find enough workers and have to pay way up to get whoever they can get. Houses are so expensive that they've become a hindrance to the economy instead of a help to the economy. When home prices reach a certain level, the bad parts of the bubble outweigh the good parts, because your real estate taxes go up and your kids can't afford a house and blah, blah, blah. It just goes on at the peak, and we're there now. Mm-hmm. So I think that even though these statistics need a lot of analysis, when you do analyze them, they're pointing towards the cycle coming to an end pretty soon. Mm-hmm. Because if we're tight in so many different areas, which we seem to be, and interest rates are rising, then you have this collision between excessive valuations and higher cost of money that has traditionally brought expansions to an end. So I think that's kind of where we are. And we don't want to get too bogged down in whether this stat or that stat is being reported honestly, when so many of the anecdotal and official numbers are all pointing in the same direction, which is overheating and imminent downturn. So I think that's probably the story of 2019, is that we get this collision between expensive money and overpriced assets, and we end up with 2008, Absolutely. 2009 again. In other words, some kind of a financial crisis brought about by excessive debt and multiple financial bubbles.
And they happen periodically. You could argue they happen every 10 years, and real estate's probably 17 years, the cycle. But probably the date to look out for, I think this is going to go on for a while because the debt just keeps going up and up and up, is 2021. I think that's the year where the chickens come home to roost. The Trump will have been reelected, and then the House of Cards will be allowed to go the way it's going to go, I think. But hey, nobody can tell the future. It just looks like that's a good cycle number. It's already 14 years since the beginning of the financial crisis. Anyway, like I say, nobody knows the future. We can only guess at it and try to grasp it. So, John, just looking at last Friday, we'll just talk about this. It looked like gold and silver were getting ready to spread their collective wings, and unfortunately, their wings got nipped in the bud, huh?
Yeah, they got whacked on Friday. Especially silver. It looked like it was making a good run. It was outperforming gold. It was up in the 17s, headed for 18, and then it got knocked down by almost $1 from high to current low. But this is the time of year when stuff like that happens. We're in the summer doldrums for precious metals. Mm-hmm. And there are a lot of seasonal factors that still work. You would think that if every single year, starting in December or so, Asians started buying a lot more gold and silver, and that pushed the price up, that the traders would get in there and arbitrage that cycle away. But that's not how it works. Summer is slow for gold and silver, and the end of the year and early in the next year are the hot times for it. So we're in the slow time now, when you should expect trading to be really boring. In other words, a little bit up and a little bit down, and just choppy, yes, non-goal oriented trading in the markets. But that'll change maybe in September. Frequently, the markets start to anticipate the big run up in December and January by going up in September and October and November. So maybe we could see that again. And that's not that far away. So if you're watching your gold mining stocks, for instance, just tread water and you're really bored, your boredom won't last much longer. It'll get exciting again pretty soon.
Yeah.
And when it does, a lot of these things are coiled springs. We've got a lot of really high quality, especially junior miners out there that have brought in some good results, but their stock prices don't have anything to show for it. Mm-hmm. So when the metals start moving up, people start looking around and finding a lot of really interesting prospects out there that will really take off because they're way cheaper than they should be based on recent drill results and recent financings, et cetera, et cetera. So you can see a lot of doubles and triples on a 10% or 20% increase in the underlying metal among the exploration companies and junior miners in general. So I think that's where the action's going to be, and I think it's going to be fun when it finally happens.
Oh, it's going to be a ball, and it'll happen when you least expect it. When you're feeling most down about precious metals, that's when it always happens, folks. You can be certain of it.